great to be here. Thank you for having me. This is actually my third time in the GCC, and have a fantastic time whenever I'm here. Everyone's so hospitable, so thank you again. We're going to talk about three things today. First, I'm going to give you a quick overview of AngelList and who we are. Then I'm going to talk about why I think it's the most exciting time ever to be investing in technology. And then finally, I'm going to give a few tips for how I would recommend investing in technology if you're just getting started. So here's AngelList. We call ourselves the backbone of Silicon Valley, and increasingly we'd like to think that we're the backbone of technology in the world. We're a holding company, and we have 4 different businesses, and each of our businesses was designed with the idea of helping startups achieve more. So we have an investment platform where we connect startups with investors. We do 200 to 300 million per year in investment, mostly into early stage startups through that platform. We have a recruiting marketplace where we connect startups with designers, engineers, other people that you need to build your business. And in terms of startup recruiting, we think we're bigger than LinkedIn. So we have 6.5 million users, 500,000 companies, and we do 1 million introductions each year between startups and people that they want to hire. We acquired a company called Product Hunt. What Product Hunt does is help companies find their initial customers, and there have been over 100,000 different launches on Product Hunt. And our last venture is called CoinList, which is in the cryptocurrency space. And regardless of what you think of cryptocurrencies, we saw an opportunity to sell picks and shovels. So CoinList is a cryptocurrency compliance services company. So everyone who's trying to do a token, the question is how do you do it compliantly and list it compliantly? We're very good at that, so we created a platform for it. So to give you an idea of how crazy the space is, our investment platform, which started in 2009, does 200 to 300 million per year, and CoinList did 206 million in its first deal. So it's a little bit wild. All of these businesses generate revenue. We've also raised a considerable amount of equity funding. Mark Andreessen, the founder of Netscape, Ev, the founder of Twitter, Max, the founder of PayPal, are all personal investors in AngelList. And this is how it all started. It started as an email list where we would connect angel investors, largely in Silicon Valley, with companies. And in 2010, we offered a number of people an introduction to Uber when they were raising their seed round at a $4 million valuation. And this is what the email looked like. It's a little bit funny. You'll see that it wasn't even called Uber. It was called Uber Cab. It looks pretty junky. They were only doing 10 rides each weekend in SF. And Travis and Garrett weren't even marketed as the founders. They were marketed as advisors and people who were investing. And then they later jumped in with the full founder branding. We offered 165 different people introductions to Uber. 150 of them didn't reply. One of them actually unsubscribed from the email list after they got this. 15 of them met with the company, 5 of them actually invested, and if they sold their shares into the SoftBank tender, they did a 3,600x return on their money. So 25,000 invested is about 90 million. So that's how it all started with individuals. Now we've raised institutional capital and largely moved private and working with bigger investors. These numbers are a little bit lowballed. We have 600 to 700 million under management. We think we're doing probably close to 10% of all early stage activity in the US and somewhere around 20%, maybe 30% of all good early stage activity in the US. Not all of these deals I would recommend investing in, but we're a platform and we facilitate the transactions. So that's where we are today, and here's my thesis on why I think now more than ever is a great time to be investing in technology. A lot of this is geared towards Silicon Valley and companies in Silicon Valley, but I think a lot of it's also true for startups in MENA. So technology has changed the world. Not only has it changed the world that we live in, because we all have iPhones and we can order an Uber or a Careem, but it's also changed the world of starting companies. So, just a few years ago, if you wanted to integrate payments into your app, you'd have to integrate with an acquiring bank and it would take months and be an extremely difficult process. Now, starting 2011 with Stripe, you could do this in 10 minutes. Similarly, before Amazon Web Services in 2004, if you wanted to go and start your company and have users in different parts of the country, you would actually have to open a data center everywhere. Now you just host all of your infrastructure in the cloud. If you wanted to acquire users pre-Facebook, you would need to acquire every single user individually, which was a really painful process. Now you get your first user, you get them to authorize Facebook, you know exactly who their friends are, and now you get your next 100 million users that way. So as an example of this, in 1997, you'd fund a team. The first checks that VCs were writing were big because it took a lot of capital to get companies off the ground. You'd give $5 million to a company and a team of 20 or 30. It would take them 2 years to actually bring a product to market. Versus today, that could be done by a single kid in his garage with $50,000 in just 1 month. So at the same time that it became faster and easier to start technology companies, the market sizes that the entrepreneurs are attacking are also much larger. So one way that I define market size, this is a very crude approximation, but it's the number of internet users multiplied by how much they're each spending online. And if you looked at what's happened with these trends over the past 20 years, the number of internet users has grown roughly 70-fold, and the amount that they spend online has grown roughly 19-fold. So if you were to multiply these numbers, you'd say that market sizes are 1,400 times bigger. It's not exactly like that because users spend different amounts of online all over the world. But I'm going to be conservative here, and I think that the market sizes that entrepreneurs are attacking are at least 100 times larger. So the result of this is that the leverage you get as an angel investor is up by orders of magnitude. And I define leverage as how big the market is that the entrepreneurs are attacking, divided by how much cost, what's the funding that's required for them to go out and achieve that market. And you saw what happened with these trends. The addressable markets are now 100 times bigger, but the cost of starting technology companies is down by a factor of 10. So the result is that every dollar you invest in a startup today is 1,000 times more levered than it was 20 years ago. So yes, valuations have increased, but you have 1,000x more leverage. And I think the best case study of this is WhatsApp. It's a little bit of a rigged example because WhatsApp is actually the most leveraged company in history. But with just 35 engineers and I think 52 or 53 total employees, they sold the company for $19 billion. And they reached double-digit % of all mobile internet users in just 6 years. And never before was this type of value creation possible with so little resources so quickly. And that's the power of technology and why I think it's really special to be investing now versus just a few years ago. So with that, I'll give a few of my tips now for how I would think you should go about investing in technology companies. So the first, we got them all up here at once, is that I think you should consult with the experts. So if you're new to angel investing, you should find one person or a number of people who are experts in technology to guide you in this process. And they should be a specific expert in technology, like your Swiss banker, your financial advisor, your real estate person. They probably know nothing about technology. So you should find someone who knows something specifically. I think the team at VentureSouq is fantastic. I promise they're not paying me to say that. I've worked with them over the years. I've worked with them over the years and think they are great to consult with if they have the time. Two, you should set a budget. Normally, you should put single-digit % into venture as an allocation. I personally choose to do more, but I think it's good for everyone to say have 1 to 5% of their assets into the venture capital asset class. With that, it's important to diversify. And there are two elements to diversification. Number one, you do want to diversify over the deals you're doing, right? If you invest in just a single startup, that's risky. If you invest in 30 early stage startups, that's not really as risky. But you should also diversify over time. You shouldn't take your entire amount that you want to invest into venture and do that in a single year, because how do you know that's a good year? Maybe Google or Uber or Airbnb are in the future years, and if you did it all in 1 year, then you kind of miss out. So I think when you set your budget as to how much you invest in venture, you should plan to do maybe 1/10 of that amount every single year for the next 10 years. And then you'll start to see the returns coming in. And if you choose to increase your budget, and as you see the markups, you could do that. You need to be very patient. Don't call the founder and say, where's my money? Venture as an asset class takes a long time to mature. The best startups, if you look at Uber from 2010 to 2018 when we first had liquidity, that was 8 years. And if you look at the venture capital asset class as a whole, it's one of the best performing asset classes in the world. The 20-year IRR is 63%. But it's illiquid most of the time. I think the best things in life are ones where you need to wait and you need to be patient, and venture capital is a reflection of that. I think you should pass by default. There's a saying in Silicon Valley, FOMO, which stands for fear of missing out. And investors get that a lot when they see a hot deal. They're like, oh, I need to do this, I need to do this. I have one day to close. My expression is no FOMO, so no fear of missing out. If you're being rushed, if you don't like it, you don't have the time to analyze, if something doesn't smell right, just pass. Every deal that you see is going to be as good as the next one a priori. Only after the fact do you know. So if you're not sure you're being rushed, just sit out. I think you should invest with the best. So there's no way to know whether a deal is good at the time you're doing it. You're able to evaluate and see. You only know after the fact whether it's fantastic. So I think a very good proxy to use when you're getting started is make sure that you are co-investing with the best investors. If you're investing in MENA, make sure you're investing with MENA-based angels and funds who have a track record of getting into the best companies. If you're investing in Silicon Valley, you want to be investing with angels and funds who similarly have a great track record. And it shouldn't just be blindly looking at it. You also need to understand how much these people are investing and what their incentives are. So if Sequoia is investing in a company, but it's one of the partner's younger sisters, and otherwise the company doesn't look that attractive, maybe they're doing it because they're conflicted. Another thing to watch out for is bridge rounds, throwing good money after bad. If I invest $1 million in a company and then I'm putting another $250,000 in, that's not a sign of confidence. Just because I'm co-investing doesn't mean that it's good. I already put $1 million in now, and now I'm putting a smaller amount. Maybe I'm trying to save the company. So you want to make sure that when you're investing with the best, it's arm's length, unconflicted transactions when people are writing checks that are significant for them. And lastly, which I think is the most important, you want to watch out for adverse selection, especially if you're seeing deals from Silicon Valley. Say, why am I sitting here in Abu Dhabi seeing a deal from Silicon Valley? How do I know that it's good? Similarly, if you're seeing deals locally, why as a new angel am I seeing deals? How do I know that it's good? And you should really monitor that aggressively. And by making sure that you invest with the best, that's a good way to protect yourself against it. Another way that I recommend kind of solving the adverse selection problem is by investing in funds. If you invest in good seed funds, both locally and in Silicon Valley, one thing that I recommend doing is asking for follow-on rights. And what that means is, as the companies mature, oftentimes the funds have a contractual ability to write checks into later stage rounds. If you write a big enough ticket into one of these funds, you could say, I want the follow-on rights, and then you're guaranteed an opportunity to invest. So you know why you're seeing the deal. You're seeing the deal because one of the funds that you were invested in is invested in it early. And then the one thing that I'd add for this on MENA that I think is important is you want to be valuation sensitive. In the US, people are attacking really big markets. They could go to effectively infinity in size. Here, I think one of the challenges as you try to scale is that each region is a little bit different, and sometimes growth could be a little bit slower because they need to figure out the peculiarities in each place that they're launching. So you're going to want to negotiate lower valuations than you would, say, investing in Silicon Valley, because you want to make sure that you're compensated appropriately for the risk. And then just a few closing thoughts. So VC-backed, I consider to be the same as angel-backed, but these are increasingly driving the whole economy in the US, and I think this is going to be a trend internationally. In the US, all 5 of the largest companies started with venture and angel funding. It used to be the Exxon Mobils and Shells and Berkshire Hathaways of the world. Now it's technology companies. And lastly, I think the time is always right for innovation. So, and what I mean by this is you shouldn't get psyched out in terms of what's happening in the world. Once you set your budget, you should continue to invest. If you look at these companies, the slide's a little messed up, but PayPal, they had to raise a funding round in 2000 when the world of technology was collapsing. When Facebook raised its financing in 2004, everyone thought that Silicon Valley was dead. There was the bubble. What's happening there? If you look at Airbnb and Uber, they had to raise rounds during the financial crisis in the United States. So basically at any time in history where a good company's being started, someone could look at it and say that the macro situation's messed up. So I think you should be mindful of this and always continue to deploy in venture. Thank you. Do you have time for questions or no? There are questions? Yeah, that's a great question. I'll repeat it. Yeah, the question was, what do I think about ICOs, initial coin offerings, versus VC and angel investment? I might be a contrarian versus some of my peers who are, really big fans of the initial coin offerings. I think the space is going to cool, and it's already cooled massively. And if it continues to exist and be meaningful, I think that it's going to reflect venture investment more. So if you look at ICOs, there's crazy stuff happening. A team with just a white paper and 3 employees raises 200 million, right? When have you seen a venture capital firm say, oh, this looks like a great seed stage company, I'm going to put 200 million into it? It's never happened. So I think what's going to happen is that it's going to move and look a little bit more rational. So instead of raising $200 million in your ICO, you raise $2 million in your ICO. And then if you do well, you'll raise another round of funding in another ICO or something like that where you raise $10 million. And I think it'll scale more akin to the traditional seed and Series A and Series B venture. I think what's happening now is not sustainable. The question was whether there's any restrictions for US-based startups operating in the MENA region. I'm not sure. What I do know is that from my time here, everyone's been extremely welcoming. And if startups that I'm involved in wanted to enter the MENA region, I would encourage them to do so. I know in a few of the places I've traveled as well, the governments have initiatives where they're trying to promote startup growth and direct investment and creating jobs locally. So my guess would be that it's a friendly place to do business, but I don't know for sure.